From signs of slowing economic growth to trade uncertainty and geopolitics, lots of drivers in the commodities space right now. But our guest today says seasonality also at play. Joining us now with more is Tim Yang, VP with TD Asset Management. Tim, great to have you on the program. Your first time. Looking forward to the conversation.
Thank you for having me.
All right, so we know about the other things. We know about the trade uncertainty. We know about the geopolitics. But you talk about seasonality being a part of the commodities trade. Walk us through that.
So commodity consumptions have seasonal pattern. One example is gold. If we talk about winter from November to February, people like to buy gold. The reason for that is the Indian wedding season as well as the Chinese Lunar New Year holidays. So people like to buy gold as a gift for their friends and families. Then if we move on to spring, the demand for copper tend to pick up. That's because it lies in the Chinese construction season, peak season, the weather is favorable. Then we move on to summer, the demand for oil starts to pick up because that's summer driving season. People like to take vacations. So when we think about commodity trade, seasonality is a big, important factor to consider.
All right, seasonality, and we often overlook that, right? Because we get so caught up with the other big headlines, and they are big headlines. You mentioned gold there. Let's dig a bit deeper into it. Obviously, it has had a great run. It's had a record-breaking run. It's come back a little bit. What's driving that performance, and what do we think about gold going forward?
Yeah, so gold is one of the best performing commodities over the last year. Price appreciated about 40%. And the main driver, we believe, is the global central banks, and particularly emerging market central banks has continuously purchase of gold program to diversify away from US dollar FX reserve. And that indicated the global central banks have growing concern about political risk of holding those US assets. One of the evidence we see is gold start to not responding to rising dollars and rising interest rate. So in our view, this global de-dollarization theme is unlikely to reverse in the near term, and this gold bull market run has further upside to go.
Okay, that's gold. Copper, that also touched on seasonality, but obviously there's other drivers at play as well. What are some of the potential drivers for copper?
So copper is a very interesting one. The price responds to supply-demand balance, which is fundamentals. It has also macro factors that impact for this. We normally talk about Dr. Copper because copper is a leading indicator for global manufacturing cycles. In the long term, our view of copper market in structural deficit still intact. The mine supply is forecast to peak around 2026, 2027. The demand for copper is forecast to continue to grow because of the electrification, energy transition, and the AI-related data center build-out. In the short term, though, the copper market is somewhere balanced. However, a lot of macro drivers are in play right now. Number one is the U.S. tariffs that U.S. wanted to bring manufacturing jobs back home. We see copper has been responding, been moved inside the U.S. Then we have China, that Chinese company has been stockpiling copper in anticipation of a stronger stimulus from the Chinese government, also ahead of the construction peak season. The third one is Europe. So if there's a potential ending of the war between Russia and Ukraine, then Europe started to think about rebuild of Ukraine and also increase the defense spending. All of a sudden, we have a lot of investment demand for copper on top of the regular industrial demand for copper at this time of the year. So the balanced copper market started to get tightened. That's why we've seen copper price has been appreciated about 10% to 15% year to date, depends on where you are.
As part of the copper thesis there, you mentioned China. It's pretty hard to have a discussion about commodities and the appetite for commodities across the board without talking about China and their demand. How's that looking?
So China's growth has been slowing, and the main drag is property market, as we know. However, the commodity demand, particularly industrial metals demand, hasn't been slowing. We have identified that China has been in transition from the old real estate property market driven model into this new productive drivers. There are three of them. We call them three pillars. The number one is manufacturing upgrade. One example is EV. China has sold more than 11 million EV last year. It's more than 60% of the global EV sales. And this year is forecast to be 20% higher than that. Number two is energy transition. So Chinese government have announced in 2025, they're going to invest 825 billion yuan for the power grid. And this is a record high numbers. This is very important because Chinese grid is responsible for 20% of the global copper consumptions. The third one, as we all know, recently the AI competition between US and China, and that trend will continue. And China, Alibaba has announced recently that they're going to double the capex expansion in 2025. So in our opinion, as long as China's property market is less of a drag this year, then the commodity demand will be coming from the three pillars we just mentioned. And it might be a bright spot in 2025 and the years after.
Okay, so there's a lot going on. Obviously, there's always a lot going on in the commodity space. You've broken it down nicely. An investor listening to this conversation, they're thinking about the role that commodities can play in a portfolio. What should they be thinking about?
So when we think about putting commodity in the portfolio, there were three reasons. Commodity can hedge inflation, can help with portfolio diversification, and also commodity sometimes have impressive returns in certain periods. If we look back, what we are right now in terms of the world situation, the last 20 years of globalization trend is likely to reverse. So suddenly every country after its own interest. US trying to bring manufacturing job back home. China does its own thing, is in recovery. And then Europe started to think about rebuild. Suddenly there is a lot of investment case to make. If you are investors, it doesn't have to be all concentrated in one area. We'll talk about US technology stocks. You can invest in Europe or China and certainly in commodities.
Okay, so interesting stuff there. We've laid out a lot of things that are working in the favor of commodities this year, and you said in the following years. What about some of the risks out there to the commodities trade?
For sure. So the biggest risk to our view is if there's some sort of global recession that caused by US tariffs, then it's going to be really bad for commodity prices as well as most of the risky assets.